Hello, everybody. It is great to be here with you, even though only virtually. First of all, I would like to thank the organizers of the Digital 360 Summit for inviting me, and only wish I could be with you in person. Very briefly about myself. I have been at Stanford as a professor of finance, specializing in venture capital and innovation for about 20 years. I'm a professor at the Stanford Graduate School of Business. And I've been teaching a very popular class on venture capital for many years. Hundreds of my students became founders of venture capital-backed startups. Many of them became unicorns. And many of my students became venture capitalists, investors, backing young, amazing, exciting startups. Many of those startups became quite successful. And over many, many years of teaching future investors and future entrepreneurs, but also doing research, I founded the Venture Capital Initiative at Stanford Graduate School of Business. I realized that venture capitalists, when they back entrepreneurs, when they make decisions, they make those decisions differently. They organize their process differently. And what I also realized is that those processes, that different decision-making capability could be very useful for everybody far beyond Silicon Valley, for everybody who is making decisions every day, strategic decisions, practical decisions. And I know this because I worked with the CEOs, with the regulators, with the senior executives of many large companies around the world on how to apply what I call the venture mindset. And so today's lunch talk is going to be about how to decode and apply the venture mindset. But very briefly, just for those of you who need a little bit more meat about what venture capital is. So venture capital backs young startups. Venture capital is disproportionately located in Silicon Valley, even though these days you can meet venture capitalists everywhere, from coast to coast, from south to north, and around the world. What is amazing about venture capital industry, and what many people are unaware, is that VC has a disproportionately high impact on the history of the economic growth in this country. And let me show you just a couple of numbers. If we look at all the companies that became public in the United States in the past 50 years, it turns out that every second company was backed by venture capitalists. And if you look at the research and development expenses of all the public companies that were founded approximately in the last 50 years, then out of each dollar spent on R&D, 92 cents out of each dollar was spent by these companies that used to be venture capital backed. And if you look at top companies by market cap in the United States today, then, well, depending on the durations of various stocks, the specific numbers might change. This is from my LinkedIn post a year ago, but I think it is more or less hold for a year or so. Then 6, 7, or 8 out of top 10 companies by market capitalization in the United States were VC backed, and you all know them: Apple, Microsoft, Alphabet, Amazon, Meta, Nvidia, Tesla, and so on and so forth. And so the question is how these venture capitalists make decisions to identify those companies that become top, that change our life. With a former student of mine, Alex Dang, I co-wrote a book, The Venture Mindset, which is about how to make smarter bets and achieve extraordinary growth. And I think that every single one of you should benefit from getting this book. And we wrote it as a page turner, so that it's not just practical and very useful, but also is a cool read. And we also have the UK edition that came out, as well as the South Korean edition, and about 10 more editions are coming out in later this year and next year. And I'm very honored to have become the national bestseller in the United States and Financial Times Business Book of the Month as well. Okay, so let's start with the venture mindset. So the venture mindset is organized about 9 key principles. And for each principle, or behind each principle, is the specific behaviors, specific actions that venture capitalists take, and then specific behaviors that they don't take. And we effectively took every single principle, single decision maker, and we deconstructed in a way that you can take this principle and review what you've been doing, what you're going to do, and see how you can apply those principles right away. During this lunch talk, I won't be able to talk about all the principles, but I will try to cover a couple of them. Let's start with the first principle. Home runs matter, strikeouts don't. What this means? Now look at this chart quite carefully. It is a very simple visualization, a very deep insight from our research. If you look at typical 20 investments made by early stage venture capital firms in this country, then a large majority of those investments, around 14, 15, 16, will fail. They will lose money for investors. And then several investments will be, in fact, quite successful for a normal traditional investor or a normal traditional corporation, so that for every single dollar invested, you will get back $2, $3, $4, sometimes $5. And this is what I call 2 to 4x. But for venture capital investors, those returns are not sufficient to cover the losses. And then historically and statistically, only 1 out of 20 of these bets will result in a very large breakthrough, very successful return. So I call it 100x, and statistically 1 out of 20 does return around 100x. So for each dollar, you're getting $100 back. And as a result of this, if you look at this graph and the entire outcomes of the venture capital industry, especially those investing in early stage projects, in early stage startups, are all about trying to maximize the probability of getting into those 100x home runs. What is more important, though, is that failures as a result not only don't matter, but in a way, these strikeouts are important. The whole idea behind principle number 1 that I find useful for executives, let's say in large organizations and more traditional organizations to think about, unless you are comfortable or unless you will get comfortable in having strikeouts, you are very unlikely to get home runs. Let me give you an anecdote. I was advising once the CEO of a large traditional company about innovation. So I often work with the CEOs of large companies, the boards, the chairman, the owners on innovation-related topics. So I was advising him, and we had a meeting with about 7 or 8 of top people in the company. And I talked about this principle. And at that moment, he turned to his chief innovation officer, or the person who was in charge of running, among other things, the innovation accelerator. And the CEO asked, interesting, so how many failures or how many strikeouts do we have in our accelerator? And there was a very, very proud response. None. Well, my response to that was, that also means likely you have no home runs. You have no 100x returns that will dramatically change for the better your top line and your bottom line in the company. So if you would like to get a new business model, if you would like to get another business unit, if you would like to really compete in this disruptive era, then you have to become comfortable with the strikeouts. So that is the big message of principle number 1. Now, as a result of this, when we go back to VCs hunt for those home runs, for those outliers. Just to give you a couple of quotes, Alex Rampell, who is a partner at Andreessen Horowitz, a venture capital firm in Silicon Valley, said, "Heirs of a mission are much bigger than heirs of commission." And another famous venture capitalist, Bill Gurley, partner at Benchmark, another VC firm in Silicon Valley, said, "If you invest in something that doesn't work, you lose 1x your money. If you miss Google, you lose 10,000x your money." So this is how venture capitalists live and breathe. If you look at successful companies, they're doing exactly the same. For example, if you look at Amazon, then Amazon is quite famous for having a lot of strikeouts, but obviously they also do have a lot of home runs. In fact, Jeff Bezos, when he was the CEO of Amazon, he said that the size of our failures should grow with the size of the company. The way to think about this more methodologically is to think about the power law. We all accustomed to think about normal distribution. If you remember your high school or your college probability, statistics, math classes, I'm sure you remember normal distribution. And it's called normal because it's all around us. It turns out it's not around us when we get to innovation, the outcomes of innovation. The outcomes of disruptive innovation is driven by what is known as the power law. And the idea behind the power law is kind of straightforward, which is the winner takes it all. The startup that is the best in its class will be better than most other startups, or actually all other startups. The company that will be number one in the industry will be more valuable, more profitable than all the other companies in its industry. And if you look at the industries that are backed by venture capitalists historically, you'll see that those industries, those verticals, tend to be driven by the power law. If you look at Silicon Valley today, then venture capitalists are now backing all the industries, including every single of your industry, which means that there's going to be a big change in the industry competition. And this big change in the industry competition will also mean that most, if not all, industries of the future, and when I say the future, the future is coming pretty soon, is going to be driven by the power law, not by the normal distribution, as we kind of get intuitively accustomed when we approach, for example, the dynamics of industry competition. Now, what are the specific devices that venture capitalists use? And what devices I recommend executives to use? Well, one mechanism that I find very, very helpful for everybody, definitely for investors, but also for founders and for senior executives and decision makers in more traditional companies, is the device I call the anti-portfolio. Now, we all know what portfolio is. Portfolio of stocks you invest in, for venture capital, the portfolio of companies you invest in. Anti-portfolio, the companies or the projects or ideas that you kind of considered, that were in your pipeline, in your deal funnel, but at the end of the day, you decided for whatever reason not to invest. And most people, most decision makers, once they decide not to proceed with a project, they just forget about it, right? This is not what smart VCs do. What smart VCs do is that they carefully track anti-portfolio. Here's an example of a Bessemer Venture Partners, a famous venture capital firm, and its partner David Cohen, who started anti-portfolio, keeping track of anti-portfolio at Bessemer, and made it public. So Bessemer's anti-portfolio is quite impressive. If you see all the companies that Bessemer missed. Of course, if you look at the portfolio of Bessemer, historically, it turns out that Bessemer didn't miss even more successful startups. If it turns out that your anti-portfolio is performing much better than your portfolio, though, then it is a time to step back and to think. Let me give you an example. I recently consulted with a pretty large venture capital firm. And the managing partner of that firm came to me and said, Ilya, I'm kind of concerned that our current fund is not behaving like our previous fund or previous funds historically. And I think maybe that's because we've grown dramatically, maybe because we should change our decision-making processes. So can you come in and check? And this is what I did. And the very first thing I did is I looked at the anti-portfolio. And it turned out that in the past, their portfolio was performing much better than their anti-portfolio in their vertical that they were specializing in. And nowadays, it is no longer the case. So it was time to step back and think about, and it turns out to be, in fact, going through the principles of the venture mindset, we, in a couple of hours, identified the challenges that that specific venture capital firm faced. And it turns out to be, in fact, it was relatively easy to address those challenges. So if you're not a venture capitalist, say you're a senior executive in a traditional company, you have a lot of projects, you have a lot of ideas. Try to keep your anti-portfolio in check. In fact, what I found out is that for large companies, sometimes it's even more useful, especially because sometimes if, let's say, you say no again and again to a lot of your internal projects, and some of those projects later you see developed by your competitors or maybe by startups, then it's time to step back and to think about whether you should change your approach to the way you allocate budget for internal projects. Okay, let's move on to principle number 2. Principle number 2 is getting outside the 4 walls. While every single of 9 principles is very actively followed by senior executives, and I have to say, in my various executive sessions, my consulting work, every single principle leads to a lot of excitement. I think this principle particularly resonates with the senior executives in large traditional companies. Now, let's start with the venture capitalists. So where do you find the venture capitalists more often? In their shiny offices or outside their 4 walls? For example, in a cafe on the Stanford campus, in my building. It turns out to be that VCs typically spend only 1 day in their shiny, expensive offices. Most of the time they travel, they walk around, they attend meetings. They do go to a lot of coffee shops. I think they drink too much coffee maybe, because they would like not just to source ideas, but they would like to understand what is happening, because their idea is, or their goal is to find new people, new projects that are going to change the world. And this principle is truly important. If we look at where VC deals originate from, it turns out to be, and this is from a table from my research from several years ago, it turns out that their deals originate from so many different sources. And I will not go over every single one of them in great detail, but I think it is absolutely critical to understand that if you're sitting inside your 4 walls, then you actually have only one source. And I know that this is what's happening because when I compared the LinkedIn profiles and LinkedIn connections of venture capitalists with their corporate brethren, so that those inside large corporations who are in charge of corporate venture capital investments on behalf of those companies, it turns out to be that venture capitalists have much more active connections, more connections, but more importantly, more diversified connections. Connections of corporate senior executives, even corporate VCs, are much more limited. Limited maybe based on their educational background, so you have a lot of connections to the people you studied with, connections to people with whom you previously worked and with whom you currently work. If you look at VCs, they have an enormous number of connections that are much more dispersed, different educational backgrounds, different geographies, different companies, small companies, large companies, different industries. And I think that allows them to be much more in tune with the changes around us. So getting outside the four walls, I think, is really, really important. Here is a specific example based on my research. Sometimes all of us get cold emails or cold pitches. In the VC parlance, cold emails mean that you're getting a pitch deck or proposition from a startup founder whom you really don't know. They just reach out to you, let's say by email. And what do you do if you get an email from a person whom you don't know? Corporate executives tend to, well, delete those emails, even if they get into their inbox. This is not what VCs do. How did I find this out? With a former student of mine, Will Gornall, we created 50 fake startups. For each fake startup, we created founders, we created logos, we created pitches, and so on and so forth. And then we sent 80,000 cold emails to actual investors, angel investors and VCs. And what was the response rate? Now, we did not do this experiment on corporate executives, but I think the response rate would have been extremely low. What was the response rate by VCs? In fact, the result was a surprise to us, was a surprise to founders, was a big surprise to venture capitalists. Again, those were fake startups, even though we did a pretty good job, I think, at trying to concoct something that looked very realistic. Our response rate was between 8 and 15%. It turns out that 1 of 10, 1 of 6 VCs responded positively. For example, they wanted to meet with the founder, wanted to learn more about the founder, and so on and so forth. It also turns out that more successful VCs tended to respond faster, and tend to respond more with a higher likelihood. Okay. So to conclude on this principle, try to get outside the four walls. Here's some practical advice. After this lunch, check your LinkedIn profile. So LinkedIn gives you an opportunity to check exactly your connections. Try to see whether it is too uniform, whether you would like to diversify. Do it meaningfully, and try to connect to as many people as possible, and then keep track of those connections. As well as try your best to get outside your four walls. And of course, I guess going to this Digital 360 Summit is an example of going outside those four walls, which is already very, very helpful. Now, try to get more connections at the summit to people with whom you otherwise typically would not have connected or would not have talked. Let's go in the remaining time and cover one more principle, principle 4 in our Venture Mindset book, that is titled Say No 100 Times. Now, what is the reason behind this fancy title? Well, my research shows that for each investment that venture capitalists make, they consider and say no to around 100 investments. And what is shown here on this slide is what I call the deal funnel. The deal funnel means that all the startups go through various stages. We will not go through all the stages, but I think my advice to you right away is to try to ask yourself a question So for each project that you implement or that you back, how many projects do you consider? And if it turns out that the answer is small, or definitely way smaller than 100, then it's time to step back and change, especially if you consider startups or projects or ideas that are more disruptive than normal. What we also found out, and I think this is really interesting, is that smart VCs approach the deal funnel differently at different stages. So at the top of the funnel, where there's a lot of startups, like 100 startups, 100 potential investment opportunities, to get quickly to the top 10, VCs go through the decision-making process that I call fast mode, which allows them pretty quickly get from 10 to 1 or from 100 to 10. And then to go from 10 to 1, they switch to what I call the slow mode. So fast mode, slow mode, or if it's easy for you to remember, fast lane and slow lane. And what is fast lane? So fast lane is venture capitalists will use what I call a red flag approach, And I think that all of us can benefit from using that red flag approach more. It's easy to visualize and memorize that red flag approach. Just change the way you ask questions. So most of you, I'm pretty sure, when you evaluate any project that comes to you, you're asking yourself a question. So why should we proceed with this investment? Why should I back this team? And so on and so forth. In the fast lane, change the style of the questions you ask from why should I invest to why should I not invest? From why should I back this team to why should I not back this team? And so on and so forth. So adding this short 3-letter word dramatically changes the way you and your organization are going to make decisions. This is what smart VCs do. And why I call it the red flag approach is because it allows venture capitalists quickly identify some red flags that will allow them to skip that specific startup and go to the next one. What is really interesting is that when we worked on the book, we did quite a bit of research on Shark Tank, as well as Dragon's Den, which is Shark Tank's equivalent in Canada. And we looked at the reactions of sharks and dragons. And it became pretty clear that successful sharks, successful dragons do follow this red flag approach. When they ask a question, and it's pretty clear from the entrepreneur's or manager's answer that the answer violated red flag, you can just see visually that that shark or that dragon completely loses interest and just moves on to the next investment opportunity. Now, red flags are industry specific. In the early stage venture capital investments, red flags are mostly about team, because as we say in Silicon Valley, ideas are dime, and the teams are what's very important. So if the team cannot execute a great idea, would better search for another team. And another red flag is about market size. So whether the total or addressable market size is small enough, then it's not going to be interesting for venture capitalists to invest. But this could be different for your industry. So try to think about what kind of red flags are important for you that will allow you quickly to process a lot of ideas. This will allow you also to expand your deal funnel. And that means that you will be able to evaluate more projects, and this will make your project selection more efficient. I think my time is up. I was asked to talk for no longer than 30 minutes. We briefly discussed 3 principles. There are 6 more. And of course, even about those 3 principles, there is a lot of other stuff that is interesting and very practical. So my advice is to get the venture mindset book, and I wish you good luck, and do stay venture minded. Bye for now.